Okay, good afternoon and welcome back, everyone. Happy Thursday. Welcome back to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And we've had a bit of a crazy week in the markets. We've started to turn a little lower. However, I do find that these market conditions that we're currently seeing provide some opportunities for us as traders because the last few months have been a little bit boring. Not a lot of volatility, not a ton of opportunity as well. As markets start to turn lower and volatility starts to pick up, I think these are actually some of the best times for picking specific stocks and finding opportunities. And today we're going to talk about a topic on how to actually leverage these directional views that we have in the market with the minimal amount of risk. And in turn, what that will do for you by reducing your risk is allow you to maximize your returns on your directional bets. So 285 right now on the S&P is a pretty big level for us to keep an eye out for. If it does break below, I think we're going to see some continued downside, which provides us some more opportunities on the short side, which we're already positioned for through our daily plays. And what we want to do today is really discuss one of my favorite strategies, vertical debit spreads. And again, the reason that it's one of my favorite strategies is because of the fact that it's very good at helping you control risk when you're taking a directional view in the underlying stock or ETF. And it's really all about deploying your capital efficiently for the directional exposure that you're seeking so that you can maximize your return by minimizing your risk. So I'm going to try to keep things really simple, despite the fact that this is a more advanced and complex option strategy, especially for those of you that are brand new to options trading. But I will try to break this down in a way so that anyone can understand, because debit spreads are really just graduating from buying calls or puts. So if you have a basic understanding of buying calls or puts, I'm going to frame this hopefully in a way that helps you understand how debit spreads are really just an evolution of buying calls or puts that make your trading more efficient. So I'll go over a few things. I'll talk about the what, why, and how of vertical spreads. And from my perspective, I want to show you as many examples as possible because I think that's the best way to learn. So the goal with this webinar, just like all of our webinars, is to try to show everything to you in a way so that you become self-sufficient in being able to utilize our platform Options Play to be able to analyze and execute these trades and the strategies that we're showing you here today on your own. So let's go ahead and get started. So so everyone knows, this webinar is recorded just like all of our webinars, and you will receive the slides with the recording about 30 minutes after we finish here today. So before I get started, just a quick disclaimer: what we're talking about here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, if you do not already have an account, I highly recommend you to sign up for a free trial. I will post this link in the chat window for those of you that are in the chat to be able to see how to sign up for the platform that we're going to show you here today. And membership runs just $75 a month or $500 a year, which gets you access to a free 12-step options trading course. Many of you that are current subscribers have asked me how to access this course. You can also access it through the link below, and gives you access to daily options trading ideas, which predominantly uses these debit spreads that I'm referring to here today. So if you're subscribing to that and you are learning about this strategy, I highly recommend you to take the time to learn this strategy for your own trading. So let's go ahead and get started. What I want to talk about, number one, is what are debit spreads, just to define what they are, how they're constructed for those of you that are new to this strategy. And again, I want to frame it in a way so that you understand how it compares to buying a call or a put, which is a simple option strategy that I think most users are familiar with. More importantly, I want to talk about when should you actually use them, because debit spreads are really useful for a very specific type of trading. And it's really important to understand what that type of trading is so that you're deploying the strategy correctly. Then we'll talk about, lastly, how do you actually deploy it? Meaning, what are the rules for trading debit spreads, what should you use for expiration dates, strike prices, and more importantly, how to manage those trades once you're in them. And then lastly, what I'll do is I'll wrap this up with as many examples as possible of stocks that I think are setting up for a good debit spread trade to show you how to utilize this type of strategy for the markets. So let's go ahead and get started. And what I want to do is just a quick poll here of the audience. I just want to get a sense for how comfortable users are with vertical spread. So have you traded a vertical spread before? Select as many as you have. So whether you've traded a debit vertical spread, a credit vertical spread, or if you've not traded them at all, just give me a sense for the audience here in the room. Okay, so about 2/3 of you have voted already. Looks like a very even split between debit and credit spreads. So about 55, 60% of you have traded debit and vertical spreads. A quarter of you have not traded credit spreads before. I'm sorry, vertical spreads before, and about 4% of you say that you are not sure. Okay, great. So looks like credit spreads actually just beats out vertical debit spreads. For those of you that like credit spreads, we're going to do a whole webinar next week on credit spreads. So if you're interested in that strategy, I hope to see you there next Thursday. So seems like at least more than half of you trade debit spreads. So I hope that this webinar, number one, solidifies for you the strategy itself so that you learn how to apply it properly. For the quarter of you that have not traded this strategy, I hope that this webinar illuminates the power of this specific strategy and why it's become one of my favorite strategies to trade. So let's go ahead and get started here. Let me just remove this poll here. And so first of all, what we're going to talk about is what are debit spreads. So there are two debit spreads that you can trade. The best way to think about these strategies they are defined risk and reward strategies, meaning before you get into a trade, you know how much you're going to risk and you know how much money you can potentially make. And there's a maximum on both sides so that you don't have any concerns as to how much money can I make or how much money can I lose. It's predefined risk to reward, and there are bullish debit spreads that you can trade and bearish debit spreads you can trade. And I'm going to break down both of these for you in the next few slides so that everyone understands this strategy. So before I actually jump into debit spreads, I want to talk a little bit about just buying a call, because even if you trade debit spreads today, you probably don't really think of them as a comparison to buying a call. But it's really important to understand that, to really understand the benefit of trading debit spreads. So in my first example, I have stock XYZ trading at $100. Now, for this particular example, let's say the stock is at $100 and I think the stock is going to rise. Maybe I think the stock's going to go up to, let's say, 110. So what I basically believe is that the stock is going to rise. So one of the simple option strategies that I can deploy is to buy a call option. That is the simplest option strategy you can deploy for a bullish reading. So let's say I buy a 100 strike call, and let's say that call cost me $4. Now, what this strategy provides me with is a pretty simple and easy to understand payoff graph, because now I'm controlling a $100 stock with just $4 in capital. So I have an effective leverage of about 25 to 1. And the benefit of this strategy is that the max risk is $4 a share. So instead of buying a stock for $100 a share and risking $100 a share, here I can control the same amount of stock or the same stock for just $4 a share. And no matter what happens, even if this stock plummets down to $50, I'm still only risking $4 a share and not $50 a share. And the one of the upsides to this strategy is the fact that my max reward remains unlimited, despite the fact that my downside is limited to just the $4. And this is a very attractive payoff graph if you do expect the stock to rally, because you're able to take advantage of that unlimited upside, where in the event that the stock pulls back, you have limited downside. And we call this asymmetrical risk. So you're basically risking $4 to try to make up to infinite amounts of money to the upside. Now, the one downside to this strategy, and this is the downside or the drawback that we don't really talk a lot about is the fact that paying $4 to control a $100 stock is certainly a small amount of capital. But now what you have to do is the stock needs to rise to at least 104 just for your strategy to break even. So now you're basically making not just a bullish bet, but you're making a bullish bet based on magnitude, because the stock needs to rise to at least 104 just for you to break even, which means that you can actually get the direction correct. So you can actually get the stock to move up, but let's say it only moves up from 100 to 103, you're actually going to lose money on this trade. And that's very counterintuitive for a lot of users, because I called the correction correct and I bought the call option, but I still lost money on the trade. That's not very fun for a lot of options traders to call the direction correct and then lose money on the trade, because of the fact that you have to pay a certain amount of money for that call option, and the stock needs to move by that dollar amount in order for you to be profitable. And yes, that is true only at expiration, which means that if the stock makes the move prior to expiration, you will make money on the trade. But we're assuming for now that we're talking about the move at expiration. So once we've framed buying what a call option looks like, that's when we can start looking at a debit spread. So a debit spread is really very simple. It's just still taking the same trade of buying that same 100 strike call for $4, but the reason that it doesn't sometimes make sense to pay for that $4 call option is because of the fact that when you buy a $4 call option, you're effectively betting that the stock will go to infinity between now and expiration. And in reality, chances are when I'm bullish on stock XYZ over the next month, I only have a certain amount as far as where I think it will go, or reasonably where it can go. I certainly don't think that this stock is going to go from 100 to 200 in a month. So why should I pay for all that upside? And that's really where debit spreads allow you to sell off that upside for some credits. So what we're doing effectively is we're selling a higher call instead of just buying a 100 strike call and hoping that the stock goes to infinity. What we're going to do is we're effectively selling off the gains above a certain amount for some credits. And the credit that we receive will reduce the cost of the overall trade. So instead of costing me $4 to get into this bullish trade, it's now only costing me $3 to get into this bullish trade. And just by reducing that $1 on this trade, what I've done overall is I've reduced my overall risk from $4 a share to $3 a share. What that does is it increases my leverage now, because for a same $100 stock, I'm controlling that $100 with $3 now, which means my effective leverage on this bullish trade is 33 to 1 versus just 25 to 1 on the call option. So that's going to work in my favor if things start to go, if the stock really starts to move higher. The only downside to this strategy is that I've capped my rewards, because I've effectively sold away the upside above a certain amount. So in this particular case, if I sold the 110 call, if the stock shoots up to 200, I've given up all the gains above 110 because I've sold that call option at 110. But what this does is it brings my break even down from 104 down to 103. So now the strategy, not only do I get a smaller amount of risk, a higher amount of leverage, but also the stock doesn't need to move as far in order for this strategy to be profitable. So if the stock only moves from 100 to 103, I'm at least not losing money. I'm just breaking even at this case, in this particular case. So you're really trying to skew the trade in your favor whenever you're taking a vertical spread versus outright buying that call option. And what the trick here is figuring out exactly where do you sell that call option that gives you, number one, enough credit to offset the amount of risk that the risk for the trade, but not give away much upside. That because of this, if you really think the stock's going to go to 120, it doesn't make sense to sell that 110 call and give up $20, or I'm sorry, $10 worth of upside for just $1. So it really depends on kind of your views on where you think the stock will go. But generally speaking, we'll show you a methodology that you can use across the board in helping you understand exactly where to sell your options. But right now, what we're just talking about is the concepts of the strategy, so that everyone understands why you want to trade a debit spread versus outright just buying a call option. Conversely, I have the same example, stock XYZ trading at $100, but now I'm bearish on the trade. Maybe I think the stock's going to go down to, let's say, $90. So in this particular case, if I was just a regular option trader, what I would do is I would buy a put option. So here I have the same example. I'm buying a 100 strike put, cost me $4 to buy that put, which means that I'm basically controlling shorting 100 shares of this $100 stock for just $4. And my max risk here is $4, which even if you are just a beginner options trader, that is a far better trade to make than shorting the stock. Because when you short stock, you truly have unlimited risk when the stock rallies. And whenever we're shorting, there's always the possibility that stock goes against us, and we want to make sure that we control our risks. And buying puts is one of the best ways to still get all the downside potential, because your max reward is unlimited as long as the stock continues to move lower and lower all the way down to zero, but you're risking only $4 to do so. And your max loss here is if the stock really rallies above $100 or higher. But here, break-even price, as you can see here, is $96. So again, you need a decent size move to the downside in order for your strategy just to be profitable. So this is really why buying a put option, while many times is much better than shorting a stock, can also sometimes be quite expensive. So this is really why we want to take a look at debit spreads again. So same example here, we're going to buy that same 100 strike put for $4, but what we're going to do is we're going to sell off some of that unlimited downside, because even when you're bearish on a stock, you may not think that the stock's going to go to zero between now and maybe 1 month or 2 months from now that you're looking at this specific trade. So what you want to do is you want to sell off some further downside for a credit. So here, let's say I sell the $90 put for $1. So now what I've done is I've reduced my overall risk from $4 a share to $3 a share. Again, what that does is it reduces my risk, and at the same time, it increases my leverage. And that's really the double-sided sword that you're going to be able to get by reducing your risk or reducing the capital outlay of your bullish or bearish trade by using vertical spreads. You do cap your rewards, so which is why it's important to understand how do you pick strike prices that are suitable for this. And again, that's something we're going to discuss here in a minute. But that is really the downside, if you will, to buying a debit spread. And lastly, you're improving your break-even cost on this trade. So the stock does not need to move as far lower in order for the stock to be profitable, versus when you bought a put, the stock needed to move all the way down to 96 to break even. Now it only has to move down to 97 to break even. So those are really the benefits of, those are really, the anatomy of a debit spread. Just so everyone understands kind of what you're really doing is you're just adding on top of a call or a put option to reduce the cost, which improves your returns, improves your leverage, and even offsets some of the time decay, because you're effectively short one leg while you're long the other leg. So that time decay effect is negated a little. And that's really why this is one of my favorite strategies to trade, because it really allows me to deploy my capital efficiently when I have a directional view on the markets. So now that we've discussed the strategy itself, what it is, how they're constructed, I want to talk a little bit about when should you use it, because that's just as important. So number one, it's really important to understand that debit spreads are only useful when you expect a large bullish or bearish move on an underlying stock. So they typically are best for when you have a defined move in mind, especially with a target price. And I'll go through some examples to show you why sometimes that's important. But many times, for those of you that are technical traders, you'll find that when you see a stock breaking out to the upside or a stock breaking down to the downside, these are usually followed by quick, fast moves, or large moves rather, and those are suitable for trading debit spreads. These are also very good for strong momentum stocks. And the reason I say strong momentum stocks is because these trades may also go against you very, very quickly. And debit spreads really allow you to control that risk to the downside when a strong momentum stock that you're in. So if you think of stocks like Beyond Meat, these stocks can move a large amount in a very short amount of time. And that can work in your favor, but can also work against you. And debit spreads protect you from when those strong moves go against you, from losing your entire book or your shirt on that specific trade. But lastly, it's really important to understand that this strategy is something that you do not want to use when you expect a modest or neutral move. And I have a slide on the next slide, which is more visual of this, that helps you understand the difference of when you should use a debit spread versus when you should not. So just to recap a little bit, the benefits of this is really the fact that you have lower risk on this specific trade. You get a better break-even price, so you don't have to be as right on a trade in order to be profitable. And lastly, you do have lower theta, that lower time decay, because that does allow you to stay in that trade a little longer, because you're able to maintain that exposure a little longer without having the same effects of time decay with the debit spread than you do if you were just outright long that call or put. So a more visual way to see what I'm talking about here is I have a chart of a stock that was in a pretty big triangle, was trading within this triangle, and finally a bit of an equilibrium, reached an apex, and finally broke out to the upside right here. And what we saw was a huge move to the upside as a result of breaking that massive triangle. Now, these are the types of opportunities that you want to ideally use a debit spread for, because you have a defined move back to a previous high. Maybe this was your target price on that specific trade. So when you expect that defined move to the upside, these are really ideal conditions to utilize a debit spread for. Conversely, as you can see here, a few months later, this stock really traded within a pretty tight range, where it just range bound between two levels, about 103 and 101. And it just kind of bounced around these two levels. And this is really where, because you don't have a strong directional move, but you do have a clear floor to ceiling, those are useful for vertical spreads, but just for credit vertical spreads. Again, that's a strategy we're going to cover next week for those of you that like to trade that, which it seems like many of you do. Whenever you see these types of range bound areas, that's when you can sell credit spreads over and over again on effectively the same symbol many times over. Debit spreads, on the other hand, are fairly few and you don't see opportunities to trade debit spreads on the same symbol very often, because as you can see on this whole chart, there was only really one big opportunity for a big breakout. So when you're trading debit spreads, you tend to trade a lot of different symbols at a time, versus when you're trading credit spreads, you might find yourself trading credit spreads on the same symbol over and over again. So that's the characteristics that's different between trading debit versus credit spreads. And many times a lot of people ask me, comparing debit and credit spreads, and I always tell users it doesn't make sense to compare them at all, because they're built for completely different types of environments. You should never be in a situation where you're thinking about a breakout and you're asking yourself, should I buy a debit spread or should I sell a credit spread? Because when you expect that big breakout, it is very, very clear that debit spreads are way better for you than selling credit spreads. It really shouldn't even be a comparison between the two. Because again, they're suitable for very, very different outlooks on the underlying stock or ETF. So now that we've covered what a debit spread is, what are the right opportunities to utilize it, now let's talk about the basics around constructing them, meaning expiration dates and strike prices. So number one, with any type of debit spread, which predominantly means you're effectively long an option, whenever you're long options, the general rule of thumb when it comes to choosing expirations is to really go further out in time. So we always want to go further out in time when we're buying, and we want to go shorter in time when we're selling, because of time decay. So when we're buying options, we usually want to buy a minimum of 5 to 6 weeks out. So about 45 days is usually the minimum that we want to utilize for these types of strategies, because longer dated options minimize theta, because theta is what's working against us when we're trading these debit spreads. So it's important to minimize that by using by going longer dated out in time, because that will help us also additionally negate some of the effects of time decay. Now, what that means is that sometimes you may have a trade that only takes a week or 2 weeks to play out, but still what you want to do is you still want to buy that 6-7 week option. And if the move that you're expecting happens in just a week, you can always close out that trade a week into that trade. You don't have to hold the trade to expiration. And when you're buying these types of debit spreads, you always want to buy just basically an at the money call or a put, or a slightly in the money call or a put. So a 50 to 60 delta is a good starting point. And then when we're selling our vertical spreads, like I said, it's tricky to figure out what is the right balance in terms of selling off the upside exposure that gives you, number one, enough premium to really offset the cost of that long call or put, but at the same time, not giving away too much upside, because that's really what you're positioning for. You're positioning for a move. So this is really why we always use delta to help us to select a call or put to sell. We always want to sell a 10 to 15 delta call or put. And just to explain that for those of you that are relatively new to this concept, so on a stock that's currently trading at $100, what delta tells us is the probability of the stock reaching a specific strike price. So if we're talking about a stock reaching 110, that's obviously going to be a relatively lower probability of reaching to 110 than, let's say, 105. So the 105s may have a delta of, let's say, 30, which means that there's a 30% chance that the stock will rise to 105 or higher. But then maybe the 110s will only have about maybe a 15 delta. So a 15% probability of the stock reaching at higher price. So the higher you go, the lower the probability. And we always want to use delta to select our strikes, because delta is the only thing that automatically adjusts for changes in volatility. Because if we're talking about a stock that doesn't move very much, 110 strike might have a very low probability, versus a stock that moves a lot might have a very high probability. So delta already adjusts for the volatility of the stock. So we're not just talking in percentage terms, because 10% for a stock like AT&T would be a big move, versus a 10% move on a stock like Beyond Meat will happen in a day. So delta adjusts for this change in volatility, and that's why we always use delta to select our strike prices. So regardless of we're taking a very volatile stock or a very quiet stock, it naturally adjusts how far away that strike price is. So it's really important to think about using delta as opposed to just using a dollar amount or a percentage amount to select your strike prices. And if you follow these types of methodologies, you're going to find that the premium that you receive on that short leg will offset 10 to 20% of the premium of the long leg. So think about this. Every single time you buy a call or a put, imagine getting a 10 to 20% discount on that trade. What does that do in terms of reducing your risk? What does that do in terms of amplifying your returns on that trade? Because that is really what you're going to be able to see when you're trading debit spreads. So you're going to see with this type of strategy, generally a lower probability of profit. So usually about 30 to 40% winners. Now that sounds really low for a lot of users, especially for those of you that sell credit spreads and you like to see 60, 70, sometimes 80% probability of profits. But the flip side to that is that you have very good risk to reward. You're typically risking $100 to make $200, $250, versus credit spreads where you have 70% probability of profit. For every $100 you make, you're typically risking $200 to $300 to do that. So it's really, one is not better than the other. It really just comes down to the strategy that you're trading and what your outlook on the underlying stock is. But when you're trading debit spreads, it's just important to understand that, you're going to get lower probability of profit, but you're going to get far better risk to reward. And you better be comfortable with that in order to trade debit spreads, because that is reality. So now that we've talked about the strategy, we talked about when to use it, how to set them up, let's talk a little bit about, once you're in these trades, how to manage them. So number one, we've already discussed that this strategy is something that you want to time when you expect a large move in the underlying stock. If you don't expect a large move, this is not the strategy you should be deploying. Once you're in that move, just like any other long option strategy, you always want to exit these trades prior to expiration, either at a gain or a loss. And a rule of thumb that we generally have is that you want to cut losses if the move that you expect does not materialize. So in the example that I had before here, in this example, one second. If the stock, as it starts to break out, a few days later starts to correct back to that range, that I would say the breakout that I was expecting on the stock where I thought it was going to reach this 103 level is not working out, I should cut my losses. Even if I'm still profitable on that trade or breaking even on that trade, I should cut my losses because I traded this debit spread because I expected a move up to 103. If the market starts to correct lower, then I'm wrong on this trade and I need to move on from that trade. So it's really important to understand that from a risk management perspective, because even though debit spreads are one of the most efficient ways to deploy your capital, you can reduce your risk further by cutting losses if the move that you expect does not materialize. And the general rule of thumb that we have with cutting losses and taking profits on these trades prior to expiration is you want to cut losses at about 50% loss on a trade. So if you buy a debit spread for $1 and it's trading at 50 cents or less, it's time to consider cutting those losses and moving on, because that simply means that the move you expected did not materialize. On the flip side, if this trade starts to work in your favor, if the stock starts to move higher or lower, depending on whether you're trading that call or put, we generally recommend that you start taking at least partial profits once that $1 call or put reaches $1.75 to $2. And the reason, another reason that I really find this being one of my favorite strategies more than anything else is just how easy it is to manage, because the rules here, as you can see, are really, really simple. And it doesn't matter whether you trade the vertical spreads that I show you here today, or you're trading vertical spreads based on someone else's methodology where they're picking different strike prices. The rule of thumb for managing them are simple and clear cut. When you're trading credit spreads, there's a lot of it depends, because it depends on how much premium you're receiving with relation to the width of the vertical spread. So there's a lot of rules that make it a little bit more complex to manage, versus in debit spreads, it's very clear cut. You buy something for a certain amount, it either decreases up to a certain amount and you want to cut losses, or it increases a certain amount where you want to take profits. So I find the rules for managing them really, really simple and just easier to stay on top of those specific positions than some other types of spreads. Not to say I don't like trading other spreads. I love trading credit spreads as well. It's just that these are easier to manage. So if you're brand new to options trading, or if you're short on time and you don't have the time to go through every single position every single day, debit spreads do provide you with some peace of mind, because you know you're risking less money than what you can potentially make versus the other way around for some more high probability strategies. So with that, what I want to do is I want to jump over to options play. Again, like I said, I think the best way to learn is through examples. So I just want to go through a few different examples with you guys and show you some both bullish and bearish examples. I have AT&T up here because this is one of the strongest stocks we've currently seen, with Treasury yields at all-time low. This is really the only sector, the only segment of the market that's still seeing strength, because this stock does provide a almost 6% yield when government bonds are yielding just around 1%, even on the 10-year. So we're seeing a bit of a flight to these types of high dividend stocks. So AT&T has really benefited from that. So if you are in the camp of, yields are continuing to move lower, which if you look at gold, you look at TLT, it certainly seems to be moving that way. Utilities is still pretty strong, even though that's starting to turn a little lower. But stocks like AT&T and Verizon are still pretty strong in this particular camp. And I think that if you are positioning for, bond yields to continue moving lower, these are good candidates. But being that we are at a fairly late bull cycle, I always find it difficult to go long these types of trades with a call option or even long the stock. I really like to play these with debit spreads so that I'm playing the long side with the least amount of money at risk, because on any type of pullback, I'm risking the smallest amount of capital possible. So for those of you that are brand new to options play, The tool itself is broken down into 3 sections. You have trade ideas, watch list, and portfolio on the left-hand side. The middle is our security analysis panel, and on the right-hand side is trading and income. So these 3 panels represent what I call the what, why, and how of options trading, because you want to know what symbols should you pay attention to. We have fresh trade ideas and watch lists to allow you to stay on top of new symbols that you want to capture. The middle panel is really giving you a sense for why you want to trade this stock. So we have a relative strength ranking to give you a sense for how the stock compares to the overall market. We have a trend indicator to give you a sense for how the stock is trending compared to its own history, so that you can quickly get a sense for AT&T is a very strong stock in the very overall market, and it's currently trending higher. So if I'm looking at the stock, I'm more inclined to look at bullish opportunities, which will present to you 3 bullish opportunities versus bearish opportunities, which you can always use if you want to be a bit of a contrarian. So let's first look at bullish. Our platform will always show you 3 bullish strategies: buying the stock, buying a call option, which is the first option strategy we discussed here today. And we will always also show you that vertical spread, debit vertical spread. So not only do we present these 3 strategies to you as starting points, we also pick the expiration date and the strike prices based on the methodologies I just laid out for you in the slides. So just because you learned it through the slides, it's one thing to learn it on paper, it's another thing to see it in practice. So we apply that practice for you on our strategies. So if, let's say, I'm looking at AT&T, this stock has a 6% dividend yield, it's extremely attractive from an income perspective, and you think the stock's going to continue moving higher, buying the shares will cost you about $3,500 to control 100 shares versus a call option only $126 versus a call spread only $114. And what you can do is you can utilize our platform to say, well, I would invest $10,000 in this stock. So that would buy you about 290 shares, or you can buy 3 contracts of the calls or 3 contracts of the call spreads. So $10,000 in stock versus 3.7% on the call option, which is roughly about just about a little bit more than 20-to-1 leverage, and a 3.4% of the underlying to buy a vertical spread. So as you can see here, if this stock rallies, let's say it rallies to a new 52-week high, which I think it's probably headed there somewhere in the $36 range. As you can see here, if the stock rallies to 36, you're looking at about a 4% return, a little over 4% return on the underlying stock, which in 45 days is not a bad return to make on a stock. A call option would cost you $378, will give you a $222 profit, but that's a 58% return on your capital invested of $378. But as you can see on that same move from 34 to 36, you make a $258 profit on the vertical spread, which equates to a 75% return. So that just $30 reduction, which is only about a 10% reduction from the cost of buying a call to buying that call spread, just that 10% reduction turns your return from 58% to 75%. And not only does it improve your returns on this particular trade, which is certainly very attractive, more importantly, if AT&T was to pull back to, let's say, 32, which is where it was a few days ago, or a few weeks ago rather, if you had bought 100 shares of that stock, you would risk $693 versus a call option, you risk $378 versus the call spread, you risk $340. So not only do you get the higher return if you're correct, you actually have the least amount of risk if you're wrong. And that's the risk to reward factor that you're really looking for with these debit spreads that make them one of the most efficient ways to deploy your capital. Now, what I want to do is I just want to show you as many examples as possible. I was looking at Microsoft earlier. This has certainly been one of the strongest stocks in the market. But 1 month and 6 month trends have started to turn lower. So the trend quality just started to deteriorate. We started to see a bit of deterioration here at the end of July, and things are starting to get a little uglier here just today. So what I wanted to look at is maybe some bearish opportunities. And I'm being a bit opportunistic here because this is one of the strongest stocks in one of the strongest sectors, but I do see a bit of a head and shoulders formation here. My indicators on the overall market have turned bearish, so I'm looking for more bearish opportunities. And I'm just using this as an opportunistic trade. And with these types of opportunistic trades, I want to risk the least amount of money. So shorting 100 shares would cost me 13 grand or whatever margin requirement for you to borrow these shares, but buying a put option allows me to take the same bearish directional view with limited risk for only $500. But as you can see here, if I sold, instead of buying just the 134 put, which is effectively the at the money put, if I sold the 121 put against that, so that's about a 15 delta put. So again, that's the price that there's only about a 15% chance that Microsoft is below 121 by the September 27th date. As you can see, I've reduced the cost of buying a put option from 500 to 360. That's a dramatic savings in my overall risk. And what you'll see is that if this stock does move lower, so I'm just looking at my charts here. If I'm looking at Microsoft, my first target here would be about 130, which was the prior support, but I'd also be looking at maybe 125 to the downside. So if I think that number one, a conservative target of 130, as you can see, a $3 move to the downside really isn't going to give you much. So a put option that costs you $500, you'll actually lose money on this trade. So if I expect that only a move to 130, only the vertical spread provides me with some return. Not very much, and certainly not attractive for me to take this trade. But if the stock moves down to, let's say, 125, which I think is a fairly conservative target on this trade, notice that if I shorted the stock, I make a 6% return. If I bought a put option, a very nice 81% return compared to shorting the stock. But for that same trade, even on a relatively minor move to the downside, we're only talking about an $8 move to the downside, which it's moved from 142 to 133 in the last couple of weeks. And that itself is about a $9 move. So to expect another $8 move to the downside in 45 days, I think is a pretty conservative target, especially if the markets were to correct further. You're looking at almost a doubling of your return from 81% to 150%. That's how dramatic some of these debit spreads can provide you in terms of lowering your risk. And more importantly, by lowering the capital that you outlay, it increases your return significantly on that specific trade. And this is really one of the reasons why this becomes one of my favorite strategies to use. And for those of you that are brand new to this strategy, when you hit the trade button, we show you how to enter this trade into your platform. This is designed to make this as easy as possible for you to execute into your platform. And you want to enter this all into a single trade, and we provide you with all the details on how to enter this trade. And we even provide you with what's called a strategy checklist so that you can check things like the trend of the stock, the trend of the market, the options play score, earnings dates, spread and liquidity. These are all things that are important for you, especially if you're brand new to options trading. Because 40% of you answered that you've never traded a debit spread before. So I want to address those of you that have never traded the strategy, how to actually enter the strategy into your broker's platform. And I recommend, if you're brand new, to call your broker and have them walk you through your trade. Most brokers are happy to do that, to at least show you how to execute a trade on their platform. So what I'll do is I'll just go through a few more examples here, but I think what I want to show you really is just how easy it is to plug in any symbol on a specific strategy and on a specific stock, and see how easy it is for Options Play to show you a debit spread. So here's Verizon. I'm going to take a bit of a flyer on Verizon and take a bit of a contrarian approach. It certainly is still one of the stronger stocks in the market, but the 1 month and 6 month trend has really turned bearish here in August. But as you can see, considering when the markets have sold off recently, this stock has held up pretty well. So maybe I think that I'm going to be a bit of a contrarian and say this stock might rise back up to that $58, $60 level and just kind of trade range bound, because it does provide a 4.5% dividends. So maybe the stock stays floating while the markets pull back a little. So again, I'm trading against the trend here, but this tool is really designed from the ground up to allow you to quickly look at any stock any direction and immediately know a starting point. So 100 shares of Verizon, $5,600, a call option, $187 versus a call spread, $162. So as you can see, the reduction in cost from 5,600 to 187 is significant. 187 to 162 may not look like a lot, but as you can see here, if the stock does rally back up to this 58 level first, which is my first target, my return goes from 7% to 23%, which I'll be honest, is not something I'd be interested in, is not high enough. But if the stock does rally to $60, it does look significantly attractive. So many times, this is the type of analysis that I myself will do, is I'll pull up an option like this. I will plug in some outlooks and see that, sometimes that if I think the stock's going to go up to 58 bucks and I'm only going to make a 23% return, I'm going to walk away from this trade. And the thing is that you won't be able to know how good the return or the potential return of a trade is until you set it up and put it on using a P&L simulator, because we created this tool so that you can figure these things out before you get into a trade, not after, because I've seen too many stories of users buying a call option, getting the direction correct, and then realizing afterwards that they lost money on the trade because the magnitude that they were expecting simply didn't justify a decent return on that trade, or getting the direction correct and only making a fraction of the money that you thought you were going to make on the trade. So we created this tool to allow you to really understand what are your potential risks and your potential rewards before you get into a trade, so that you're able to really prepare yourself for the trade as well, which from my perspective helps remove some of the emotional side of trading that we typically have when we're in a trade that's losing, and we're not sure what to do with it. Because if you can prepare for it ahead of time, you already know what your worst case scenario is. It makes it a little easier to cut your losses when the trade goes against you, and more importantly, it really allows you to understand when it's time to take profits on that trade as well. So with that, that concludes what I wanted to show you guys here today. I really want to thank everyone for taking the time out here this afternoon, and I hope that you guys have found this topic useful in helping you better understand the strategy itself, and more importantly, understand how to actually utilize this tool to leverage the strategy yourself using options play, and really being able to plug in any stock and instantly being able to look at some specific strategies very quickly and analyze whether it makes sense or not, because you may have a very strong directional view on a stock, but maybe sometimes the options don't make sense. And that happens quite often. So just because you have a bullish view does not always mean that there's an options trade to make. An options play is really designed from the ground up to show you that if I think CVS is going to go from 60 to 63, that there's a nice return for me, 85% return. But if I only think the stock's going to go up to 60, then I'm actually going to lose money on that trade, and I should probably stay away from this options trade altogether. So again, thank you so much for taking the time out here this afternoon. I really hope that you guys have found this useful. At this time, what I'll do is I'll open this up for Q&A. So if you want to bring up the chat window at the bottom of your screen, you can put in any questions that you have. And for those of you that, again, want to sign up for a free trial to options play, you can just click on the link here in the chat window that that you can use to sign up for that free trial. So thank you so much. And let's see what questions you guys have here. It looks like there's a lot of strategies. I'm sorry, a lot of questions already here in the Q&A window. So let's take a look. What is the circled value? See it now. Okay. Besides the options play score and profit, where can we find probabilities? Great question, Chris. So on any trade, you can always click on the options play score and see the probability of profit on a specific strategy. So clicking on the options play score will show you the probability of profit, which is right here. And that goes into the calculation of the options play score. Keith is saying, will you be talking on calendar spreads? So Keith, calendar spreads is something that is on my list to get to. So yes, absolutely. That is one of the strategies that I do plan on adding to my list of educational topics. Bill, thank you so much. I appreciate it. Bill said, illuminating an interesting platform too. I appreciate it. Roger's asking, can you again show how you get call option on Verizon? Yeah, so you just type in VZ on this, and it automatically shows up on the right-hand side. You can choose either I'm bullish. Oh, I think you were asking, how do I get a call option? Yeah, so just click on I'm bullish here at the bottom of your screen to show you call options. And you can do that for any symbol. Just type in the symbol and either select I'm bullish or I'm bearish. Tom, thank you so much. Steven, regarding SPX, I expect to have that up in the next couple of weeks. You know, we are changing market data providers, and we are working on getting that SPX feedback up. Nicholas, sorry, does the options play score include the technical analysis seen on the corresponding chart? So no, the options play score itself does not have a directional bias. It assumes an equal distribution or probability of the stock moving higher or lower in terms of returns. So the returns of stocks themselves are fairly normally distributed. So it assumes a normal distribution of potential future returns. So it doesn't have any directional bias like the technical score here, which is the technical score does have a bit of a directional bias because strong stocks tend to outperform, weak stocks tend to underperform. Michael, do you use any algos on these recommended trades? Are the trades suggested developed by Options Play? Yes, so there are some algos on the background, but the algos are there for us to help screen, 4,000 stocks down to just a few stocks. The actual decisions as to which ones to trade are actually still done by hand by me and my team. Sue is asking, Tony, how do you enter a strangle on AT&T? So great question. So on any strategy, if you want to enter a more complex strategy or a different strategy, you can click on modify. And we have a thing called the strategy constructor. You can click on that and you can construct up to 45 other different types of strategies, including straddles and strangles, whether you want a long strangle or straddle, or if you want to short that strangle or straddle, you can do that just by the click of a mouse. You can make that strangle wider, you can move the strikes higher or lower. You can do that all just by the click of a mouse using our strategy constructor. James, thank you so much. I really appreciate it. Mark, my free trial is expiring tomorrow, and I find many of your debit spreads not generate enough credit, less than a third of the cost of the long leg, to justify the trade. For example, the debit score of 107 with very wide bid-ask spreads on 2Cal, TWOU, with only a 20-cent credit on the short leg should not be recommended a vertical spread, but just a long put. So let's see. So first of all, the mid price on that is 30 cents. I generally find that the minimum, so we do actually have minimums on the short leg. They have to be at least 20 cents. So here's where dollar amounts don't really matter, because you're talking about 20 cents, which is certainly a small dollar amount, but the stock is also a very small dollar amount. So 20 cents is relative to the stock price. But here you're bringing in more than 20% of the long legs premium. So if I can reduce your long legs premium by about 10% of the long legs premium. So if I can reduce your overall trade by 10% or more, you're selling a 12.5 put. That's what 25% away from the current price in just 45 days or less than that. We're talking about 36 days. So you're talking about this requires a 30% move to the downside for you to not, or for you to feel the effects of that 20-cent move. So I strongly advocate that if you're going to buy a put option on this specific trade, that you trade that debit spread versus the long put, because if this stock even moves down to $12.50, look at how you go from 156% return to 185% return. From my perspective, I think that this makes perfect sense to sell that for 20 cents credit. This may not be related. What is the name of the trade where you make money if the stock goes up, if it goes sideways, and to a certain extent down? So that's credit spreads. That's what we're going to discuss next week. Credit spreads is a very forgiving strategy. It really allows you to make money in pretty much all or in many different conditions. However, the downside to credit spreads is that you're risking more than double the premium that you're actually collecting. You can construct them into an iron condor, but an iron condor is really just a collection of credit spreads. The slippage on the long leg is greater than the credit on 2Cal. So that depends on who you're executing. It's hard for me to comment as to who you're executing and what type of slippage you're expecting. From my perspective, when something's trading at 115 by 175 and you see this trading at 145, I would place my limit orders at 150, 155, and I would actually even potentially try to execute this as a market order, because I might get filled at maybe 148, 150 on a market order versus a limit order. It might only get filled at 155. Again, that heavily depends on who you trade with, but I tend to find that you will get good fills on this specific trade. Chances are you might collect even 30 cents on that short leg, in my opinion. Molly's asking, did a lot of options trades 10 to 14 years ago, and would individually leg into both legs, long leg first always? I have quest trade and executed a bull put spread with a bit of profit, exited trades 2 days ago. Great, Molly. I'm really glad to hear that you were able to do it in a single trade. I do recommend that when you trade these debit spreads, that you trade them in a single strategy and never break them up. Breaking them up will always make it more complex. I don't recommend doing that. Let's see. It looks like there's some more questions over here. What's going on with the market? What are the levels to watch for? From my perspective, markets have turned lower. The key level to look for here is 285, which we're just closing just slightly below that. I do want to see a significant close below 285 for us to say that this market is going to correct lower to 273. But trends certainly are bearish, and we are positioning more so on the bearish side at the moment. What is the smallest account size I can start with, please? Great question. So I generally find that, starting with account sizes less than $5,000 is challenging, because you really can't trade many trades with an account size below 5,000 without risking significant portions of your account. We always recommend that you don't risk more than 1 to 2% of your account per trade. So if you're trading an account smaller than $5,000, it's almost impossible to stick to that rule. You almost always are risking 3 to 5% on most trades with an account under $5,000. So that would be kind of the minimum threshold that I typically recommend people to start trading options with. Is it called a debit spread because there's a net debit to your account? Absolutely. That's exactly why they're called debit spreads. Is Options Play a broker? No, we are not a broker. We are just a technology provider and an educator in the options space. We work with many brokers. We partner with many brokers and exchanges to help them grow their business. But our business is simply making good education and good technology for users to use for their options trading. We don't make any money on the actual commissions or sales of you trading options. And I think it makes us more aligned with you as a user than with a brokerage firm that may be making more money as you trade your account. Are you considered a competitor to TradeStation? I don't think at all, because TradeStation is actually a potential client of ours. So, I don't think of them as a competitor at all. Harry is saying, does Options Play have a screening tool? So Harry, that's a great question. So it's actually, a screening tool is actually something that's in the works. I've been working on some new trade ideas to help you guys provide some more opportunities to find ideas, but we allow you to look through our trade ideas through our filters and being able to sort. The other way you can look at it is a watch list. I'm a big fan of using our watch list to get a sense for where opportunities are. I always look at our watch list to see what the sectors are doing, which sectors are strong, which sectors are weak, and drilling down into individual sectors so that I can find opportunities. So that's the way that we currently screen for it. But we are building some more advanced screening tools to allow you to take advantage of the technical data that we do have to find new opportunities. Robert's saying, see you at the Toronto Money Show. Just to clarify, I won't be at the Toronto Money Show. I will be at the Toronto Options Education Day, which I believe is on September 14th. For those of you that are in Toronto, I hope to see you guys there for that. Chris is saying, do you have a premium alert service? We do. We will actually talk about that next Thursday on our credit spread webinar. So if you are interested in that, please attend our webinar next week. Can this strategy be used as a hedge? Technically, it can. I do recommend you to take a look at our webinar on how to hedge a portfolio. We generally find that puts themselves tend to be better hedges than debit spreads because of the fact that when you're trading a debit spread, you are giving away some downside. So if you truly need a hedge, many times you're better off buying a put option or just a simple put. These credit spreads or vertical spreads can be adjusted after with a small premium, correct? I'm not sure what you mean by that. If you don't mind clarifying, I'm happy to answer that question. Hitesh is asking, is the check mark on the options play strategy a recommended strategy? So Hitesh is asking about I think you're asking for when a strategy has a check mark. The check mark just simply means that it's a strategy with the highest options play score. It doesn't necessarily mean that it's recommended. It just means that it has the best risk to reward ratio. So risk to reward ratio in itself is not a good reason to trade anything. There's a lot of other things that you should line up, such as the direction of the trade that you expected to go in. The check mark is just letting you know that the risk to reward of that strategy is decent. Joshua is saying some of the stock symbols under trade ideas have an options play symbol. What does that mean? So the the trade ideas that have an options play logo, these are referring to stocks that met multiple scans. So Eli Lilly triggered multiple sell signals for today, which is why it has the options play logo. Wayne is asking, I almost always modify the OP spread first shown to a better score with less cost. Is this because the time frame shown for each trade is always almost approximately the same number of days to expiration? So Wayne, you can usually adjust this to find a slightly higher options play score. I tend to find that the default one will always show you a trade that is very close to the highest options play score possible. The only thing about less cost is that just because it's less cost does not also mean that it's a better trade, because less cost also means that the stock needs to move further in order for your strategy to be profitable. So cheap is not always better when it comes to trading options. So be careful when you're adjusting just for a lower cost. Joshua, is there a way to filter stock trade ideas based on trade cost range? Example, $100 to $200 for a debit spread instead of checking all trade ideas. So Joshua, you can certainly sort our trade ideas by price, and because the price of the option is directly correlated to the price of the stock. So for example, on a $22 stock, you'll see that the debit spreads are usually in that $100 to $200 range. So you might want to just stick to the ideas on the lower priced stocks to get to that specific range. So that's one way you can do that. I really like your website. Can we have a feature where I put my thought and the website gives strategy? Let's say I think Microsoft will not cross 135 and 140 by next Friday. Then websites can show all strategies I can do for my plan. So we actually have built stuff like that historically. That was actually one of the first things that I built. But what I've realized is that what we generally do is what that does is it only finds you strategies that really do well within that one very specific opportunity. So for example, if you think it's going to stay between 135 and 140, it will spit out something like an iron condor, like this, that will give you the strikes of 130, 140. So we actually build stuff like this. However, what I find is that these strategies are completely useless in all other opportunities, which means that the market has to do exactly what you expect it to, which I'll be honest, doesn't happen very often, right? So you think it'll stay between 135, 140, maybe it ends up staying between 132 and 137. And the strategy that we completely optimize just for that one only scenario becomes completely useless in all other scenarios. So that's why we never launched it, because it's really not very useful, I'll be completely honest, to have strategies that are only useful for one very specific outlook and not any other outlook, because that's what you get when you're trying to optimize just for one very specific outlook. Can we do click fourth circle button? Not sure what you mean by that. So if you think the stock's going to stay within a certain range, best thing to do is an iron condor between those specific strikes. What you can do is you can use their range simulator to say, I think the stock's going to be between, what did you say, 138 and 140. You can even use our risk and our support and resistance levels. You can modify them, and what you can do is you can just fit your strikes just to fit your exact criteria. So here, as you can see, if the stock stays within that range, it will only have profit and no loss. But again, this will only work if the exact same thing that you asked for works, and in all other scenarios, it won't work very well. What is the difference in function between your trade and income tabs above the options play score? So the income tab is specifically geared for income strategies. So for cover calls, cash secured puts. So in the webinar that I'm going to be doing in 2 weeks, so next week, we're going to talk about credit spreads. The following week, I'm going to talk about enhancing your equity positions using options. So for that, I'm going to be using the income tab. So I highly recommend, if you're interested in selling cover calls or cash secured puts, more importantly, if you're interested in enhancing your equity positions, you should come to that webinar in 2 weeks' time. And I hope to see you there. And I will go in depth to the income tab. I have to open brokerage account with you to use trading platform. No, you do not have to open a brokerage account with us at all. You open your brokerage account at wherever you want to trade, and you utilize our tools to help you do your trading at your brokerage firm. Can you please allow to change option price so while calculating it? So we specifically don't allow you to change the option prices, because then people will put in random option prices and share those trades. We don't want that. We only want to show you prices that are actually executable on these trades. So that's why we do not allow you to edit them. Looks like that's the last of the questions here. Or Wayne is saying, I like the data manipulation that options play offers. What I would also like to see is the ability to manipulate the current price of the stock to see the results that options play will show. Well, that's exactly what the P&L simulator does. It allows you to manipulate the price of the stock to see how these options trades will perform. Raymond, thank you so much. I really appreciate it. Thank you so much for coming every single week and participating. Chris, recording available afterwards. Yes, these are all recorded. You'll get the recording in about 30 minutes. How do I sign up for the credit spread seminar next week? Keith, if you're already signed up for this one, you will automatically receive the reminder next week for it. Trevor, great webinar, great tools. Thank you so much. Michael, thank you so much. Dee, thank you so much. Molly, Kevin, can I download the seminar? Yes. Chris, yes, you'll be able to watch it. Keith, thank you so much. Joseph, thank you so much. I really appreciate it. Chris, thank you so much. So again, thank you so much, everyone, for taking the time out here this afternoon. This is one of my favorite webinars to talk about. So I really hope that you guys have been able to, see the results of that and better understand the strategy. I love talking about credit spreads as well. So I will bring that same energy next week, and I really hope to see you guys there. But I will say the new topic that I'm actually most excited about is actually the one I'm going to be doing in 2 weeks, enhancing your equity positions using options, because that's really where I think most of us sit. We have equity positions. Options allow us to adjust those equity positions in our favor to get better risk-adjusted returns on the stocks that we own. And options is really one of the best ways to do that. So it is a new webinar topic. So I really hope to see you guys there in 2 weeks. So thank you so much. I hope you guys have a great week trading. Have a great weekend, and I'll see you guys next week.